Well, good day, traders. Welcome to the weekly gold report. We're going to look at all the different facets of the gold price. And last week we turned to a more bullish star bias. We saw that breakout of 1590 when gold was priced in US dollars, and we wanted to be involved in the gold market in that situation. The trades obviously worked out quite well. We've seen gold priced in US dollars pushing up to 1689. Gold in Aussie dollars, being faded above 2,500. But if we see a weekly close above that level, we'd be looking to add to gold in Aussie dollar terms in that perspective. Yeah, we have seen a bit of a pullback, and I'll touch on that in a moment, because I think that does offer us a buying opportunity. The investment case hasn't changed. In fact, we're actually seeing better, more compelling signs playing through. But the fact is that gold is trading as a currency in its own right at the moment. Do you really want to have your money in euros? Do you really want to have your money in Australian dollars? Do you want to have your money parked in US dollars? Well, maybe to an extent, but gold is offering you that opportunity to have it priced in an alternative currency at the moment. So gold is trading as kind of this least dirty t-shirt, this best house in a fairly shabby neighborhood. And how do I know that? Well, if you look at gold priced in all these different currencies, you can see it's performing extremely well. Now, the best currency in major currencies over the last 5 days, well, you're not going to get it, but it's the euro. And why is that? One suspects we've seen some slightly better data than euro, but we've also seen this unwind of the carry trade. You've seen implied volatility really ramp up, realized volatility moving higher, and people there have been unwinding those carry trades. You've seen that with euro mex up 3.7%, which is a very, very strong move. You've seen euro dollar even moving up 0.8% as well. There's no real fundamental reason behind that, but it's just an unwind of the carry trade. As vol goes up, you've seen these income positions being taken off. And if you look at gold priced in the strongest currency, which, as I say, is the euro, you can see gold up 2.1% over the last 5 days. You look at gold priced in euros, in Aussie dollar terms, you can see that 4.3%, and gold priced in US dollars, which of course attracts the bulk of the flow, up 2.9%. So the fact is we are seeing strong gains in gold against all different currencies, and that tells me that people are considering gold as a currency in its own right. Now, we have seen a bit of a pullback in gold. We've seen the price down about 1.5% in the overnight session. People are asking, why is that? If you look at the S&P, we're down 3%. We've seen this massive move to the downside in equities. People are selling airlines. People are buying volatility. You can see that with the VIX. And if you have a look at the VIX curve, the VIX futures curve, you can see that going into strong backwardation. So the spot price sitting up at 29%, which obviously is a very, very elevated level of implied volatility over the coming 30 days for the S&P. But then we drop down. You've got a very unhealthy looking curve in terms of implied vol. Now that spikes up over the election, as you can see, going into November. But you can see strong backwardation in the VIX futures curve, and that tells you that gold, in theory, should be going higher. People talk about the idea that we've got these classic recessionary indicators working quite well. You've got the 3-month, 10-year US Treasury curve going ever deeper inverted. You've got 2s and 5s going to negative 5 or 6 basis points. The Federal Reserve are pricing, or the market's pricing in a higher chance that we're going to have to see a response from the Federal Reserve in the April meeting. You can see the implied probability of a cut there sitting at 74%. The 18th of March meeting from the Fed is now priced at a 1 in 4 chance. So the market has ramped up that expectation. So why is gold not working any better than it's doing? Well, first of all, if I look at my sentiment indicators, which I can have a look at from this chart here, you can see that the bottom pane looks at 25 delta 1 month call volatility minus 1 month put volatility. And what we're doing is when you're buying options and you're expecting that bigger move, as you pay up for those options, you get higher implied volatility. And call volatility is trading at 3.25 vols to a premium to put volatility. Now that's coming up to sort of 2 standard deviations of the 5-year move. This to me is one of the greatest sentiment indicators we can see. Above 4, that's when you start to get to extremities. Gold price generally sees a lot too much euphoria. We tend to see gold price being faded when we get to those extremities and too much love. We've got to 3.2 vols. It's telling me that the gold market's got a little bit ahead of itself there, got a little bit too much love. And if you have a look at the top pane, we can see that gold implied volatility for 1 month minus 1 year has pushed up to 1.3 vols. So you can see that people have been big buyers of short-term vol relative to longer-term vol. And that's been a big move. Now we're trading 2 standard deviations above that. So this big move in implied volatility in short term has got a little bit ahead of itself. You can also have a look at the commitment of traders report, and you can see from the top pane there, the net long positions, the net position sitting for futures at 239,000 contracts. The middle pane tells you the gross longs held by managed money, and that sits at 200. 278,000. So shorts have increased very, very modestly, but there's been this big accumulation of gold future positions, and they currently sit at a net position of 239,000 contracts, which you can see is not a million miles away from the all-time highs that set back in 2016 of 273 contracts. As a percentage of open interest, it sits around 80%. So one question is just how much love is in gold, and I think that tells you something there. I want to have a look at the influence that real yields had, and the fact is that real yield, 10-year real yields are up 2 basis points. So when you mix that with the fact that gold's seeing a bit too much love at the moment, you can see a situation where gold's had a little bit of profit taking coming through, and a lot of those that extended net long position has just been taken off the table. As we can see from this chart here, where I've overlapped 10-year real yields, or what is effectively inflation-adjusted bond yields, relative to the gold price, which we can see as that sort of white bar chart. And you can see the real yield being the yellow line, and I've inverted that. So when you can see that the yellow line's going down, in effect, it's actually going up. I've just shown the natural influence there. So generally, when we see real yields going up, gold prices go down. And you can see there that we've had this really small, modest move in real yields over the last couple of days, and that's just taken a little bit of the wind out of this very extended position in gold. So if we do see real yields rolling over again, and we start seeing the more deeply negative and more protracted move to the downside, that will again ignite the gold price and go higher. Do remember that we're currently sitting at negative 20 basis points on real yield on 10s at the moment, but that's really a million miles away from the all-time lows that we saw back in December 2012, where we got down to negative 87 basis points. We've got nominals trading at all-time lows or near all-time lows. We've got 30-year treasuries trading at all-time lows. And I guess the other big talking point as well is, if we have a look at this chart, is something that really the Federal Reserve will be looking at very closely, is the idea that inflation expectations are falling through the floor at the moment. That cannot sit well with the Federal Reserve. If you have a look at this tightening of financial conditions, we're seeing the purple line, five-year break-evens, which is inflation at 5-year inflation expectations starting in 5-year time. The rate of change to the downside is accelerating. We've broken through that consolidation range. The dollar's still too strong. Emerging markets, which we've got on the lower pane, are rolling over. But those inflation expectations are falling, and they're falling hard. And central banks need to get ahead of the curve, and that's why we think there's going to be rate cuts playing through. And I think that's going to be supportive of gold as well. Now, in terms of the technical situation, obviously we've seen a bit of money coming out of the gold price, coming from 1689 when we're looking at it in dollars. A couple of levels I'm looking at to the downside: 1635, 1636. 1636 representing the 5-day exponential moving average. When we see this really strong impulsive move up in any asset, you do tend to see that 5-day exponential moving average, or the 7-day, really guiding that, traders using that to sort of average into new positions. Until the price can close below there on a daily basis, we continue to expect higher levels playing through. 1635 representing the 38.2% retracement level of this recent move up we've seen from the 5th of February, around 1547 up until 1689. So as long as price can hold these levels in the short term and actually build a base and then look to re-establish that bullish momentum, we're still holding that bullish bias in the short term. In fact, if we get a move back above 1660, which, as you can see, is kind of like a horizontal resistance level on the hourly chart, if we get a break back above there, then we'll sort of have a bit more confidence that we can make a move back at 1689 and perhaps into the elusive 1700 level. If we're looking at in Aussie dollar terms, where we look across the spectrum, and as long as this coronavirus continues to get legs in terms of the level of concern, which we continue to believe is the case, unfortunately, then Aussie dollar is probably going to be one of the weaker currencies going forward. We've got the RBA meeting fairly soon. We don't expect a cut, but the chances are really growing of an April cut coming through in April. That's currently priced around 50-50 at the moment. And certainly if you're looking at Aussie dollar gold, then you can probably see, if we see a close above 2500, that would be a very positive situation. We saw the market really fading above that level. If you get a break above, and a closing break specifically above 2500, we'd be looking to add to Aussie dollar denominated gold in that situation as well. We're a bit concerned about euros at the moment. We don't like the euro in any kind of great capacity, but we still probably got a bit of an unwind. If we do see implied volatility staying high, that carry trade's going to go under, and certainly the euro's been that key funder there, and there's probably a little bit more of an unwind there. So Aussie dollar gold above 2500 on a close, we'd expect that to go higher. Gold in US dollars above 1660, and again, we'd be having more conviction that we can make new highs in this run going forward. But if you look at the investment backdrop, it's still looking pretty positive for gold. We're going into the Super Tuesday on the election side of things on the 3rd of March, and Bernie Sanders looks like he's doing pretty well. He's the clear front runner for the Democrat candidate. Gold will continue to be a natural hedge against election possible risk there as well. But of course, it's really about what's happening in the supply chains at the moment. It's about what's happening in the global economy. We're going to get China data coming out this weekend. It's going to be disgusting. It's going to be horrible. And if you have a look at the manufacturing numbers, the market, even though the most bearish cause is that diffusion index goes down to 35, the consensus is we get it coming out at 45, which will be a reasonable level of contraction. The service number just an expansion, but they wouldn't surprise if that goes into contraction. Yeah, how much of that's priced in? We know that China's going to be weak in Q1. People are not coming back to work as quickly as people had anticipated, though. So for those people calling for a V-shaped recovery in China, you're looking a little bit disappointed. But the more pertinent question now is how much can this affect the rest of the global economy? We're seeing clear cases increasing in Italy. They've pushed above 300. The R0 case is moving up quite sharply. There's, I think, in the last couple of days, that's pushed up 45% in terms of number of cases. This may spread into Germany. People are seeing signs of this pushing into other parts of Europe. The Middle East is clearly getting affected. We've seen the CDC in the US talking about a question of when this happens and when this hits America, not if. And there's going to be disruptions across the service sector as well. So the world has moved on from what's happening in China. The world has moved on from the impact this is going to have in Korea, who've moved this to a code red, to what's going to happen in Europe, what's going to happen potentially in the US. How much is in the price now, we're not so sure. But in this environment, when bond yields are continuing to make new lows, both on a nominal basis and more so probably on the real side, implied volatility is high, and the chances are we're going to need to see not just emerging market central banks coming to the party, but also the Federal Reserve. They are going to have to cut rates in the April meeting to meet the market, otherwise gold prices trade higher in that situation. So definitely watching this, what's happening in implied volatility, watching what happens in the coronavirus, watching what happens in the election. But my theory at the moment is that we buy the dips in gold prices. A break of 1600 on the downside probably changes that view in this moment.